Okay, great. So it's a couple minutes past 11, so in the interest of time, we're going to commence the webinar for today. So first, welcome and thanks so much for joining us. My name is Michelle Cash. I'm part of the team here at Roof, and for those who aren't familiar with us, we provide marketing automation software and ad posting services for platforms like Google Business and Craigslist. So I'm delighted to be able to introduce our presenter, Jordan Brooks. He's Senior Market Analyst for ALN Apartment Data. And he'll never admit to this, but he is a hidden gem. He's a wealth of information and an expert at pulling together and analyzing data sets and trends and turning them into meaningful and actionable insights for our industry. So he's also an avid speaker and frequent contributor to several multifamily publications, and we're really pleased and grateful to have him with us today. So just a little bit of context for today's webinar. We're coming out of, as everybody knows, a pretty extraordinary period of disruption. The industry as a whole has experienced a remarkable amount of change, from labor shortages to historically low vacancy rates and an accelerated pace of technology adoption, especially in areas such as the leasing journey. So our goal today, whether you're in marketing, leasing, finance, operations, or another part of the business, is to really provide an overview of the critical factors affecting apartment demand, because they're so important to planning and preparing for the future in our industry. So a couple of quick housekeeping points before I pass it to the star of the show. If you have questions, we decided that we're going to take Q&A during Jordan's presentation, so we'll respond as we can, and then provide some opportunity at the end as well. And then everyone today who's registered will also receive a copy of, or a recording rather, of the presentation. Okay, so without further ado, I'm going to pass it over to Jordan.
Thank you so much, Michelle. And are you seeing my slides?
Yes.
Okay, perfect. So as Michelle said, thank you so much for being here. We hope and think that this is going to be really useful information, really for anyone within the multifamily space, kind of regardless of what you spend your day working on. And we have quite a bit of information to share, so I'm just going to jump right in. Maybe, there we go. I'm not going to spend really much time on this about ALN slide, other than just to say we've been in the business. We've been in business since 1991 in the multifamily space. Specifically, started off as an apartment locator in the early 90s, and then kind of expanded geographically and in terms of the data that we offer from there. And our geographic reach in terms of the multifamily data set goes back to about 2015. More relevant to what we're going to discuss today is some methodology information. So at ALN, we gather this in-house, this data in-house, by contacting the individual properties about on a 5-week rotation, 4 to 5 week rotation. We track only multifamily, but all verticals within multifamily. So whether it's conventional, student, affordable, senior, military, build to rent, we've started tracking as well. So everything in multifamily, but only multifamily. And then the focus of our regular updates, which is going to be most of the data that we're going to be looking at on the multifamily side here today, are going to be conventional properties of at least 50 units. That's fairly typical, I think, for data providers in the industry. Mostly that's just because when we're contacting these properties on a monthly basis to update their data, if it's a small, like independently owned 10-unit property without a full-time staff, maybe, it's really hard to get those regular updates. And so just for data quality, that's kind of where we draw that line. And then we are going to look at some price class information. There have been some interesting developments at a price class level. So for price class, the way we sort of handle that at ALN, I think it's a little bit different kind of with each data provider, but we're basing that on the average effective rent per square foot of a property, and we're doing sort of a percentile rank. So that property's percentile rank in its market for that average weighted across the unit mix, and then we're assigning a property to a class based on that percentile rank. So that's kind of how that works. We sort of feel that other features that you might build into a price class categorization, whether that's location, amenities, age, renovations, things like that, that's basically all built into the price mechanism. And so we're basing our price class on the average effective rent. And with that, so kind of some housekeeping out of the way, let's jump right in. So the way I structured this really is we're going to look at some multifamily data, what's been going on kind of in the last couple of years, what some of the more recent developments have been this year, specifically in 2022. And then after that, after we've seen kind of what the numbers look like on the multifamily side, we'll go through some data in terms of some of what's been driving those results and what's going to be affecting multifamily sort of as we move through the rest of the year. So just to start off here, basically a picture of the supply and demand balance over the last handful of years. So on the left-hand side, we're looking at new units delivered and then net absorbed units. By net absorbed, we just mean sort of the net change in the number of leased units over a period of time. Which is sort of an approximation of realized demand. So the first thing you'll notice on that chart on the left probably is the huge delta between the new supply and the absorbed units last year. Obviously, by now we all know what happened last year, explosive apartment demand, over 600,000 net absorbed units. And you can see in terms of the new units over the last handful of years that new supply has remained fairly consistent, even with the challenges certainly in the last couple of years with labor, supply chains, et cetera, going into construction. In terms of output units, we've still been kind of on a shallow upward trajectory with new supply. That's something that this year I think we may see change. But in terms of the recent history of new supply, we've seen kind of a shallow upward trajectory there. On the right-hand side, we're looking at just the first half of each of those years. So the first 2 quarters, including 2022, going back 5 years. And again, there you see obviously the effect of the pandemic in 2020 on multifamily demand. We saw that effect really start to happen around March and April of 2020. So you got April, May, June in those numbers on the right-hand side for 2020 that were pretty down. You'll notice though for 2020 on the left-hand chart that demand almost completely rebounded by the end of 2020, and we really saw really from June through December of 2020, apartment demand had rebounded, but rent growth had not. That really didn't start until 2021. 2022, though, now that the calendar is turned to the new year, again, deliveries pretty consistent, slightly down from last year, but right within the range of the last few years. But you see the net absorption number there quite low, barely above where we were through June of 2020. And that's really, I think, been the main story of this year. 2020 was the pandemic, obviously. It was the resurgence in demand in the second half of the year, but without rent growth. Last year was all about, explosive multifamily demand that led to, rent growth that was generational at least. And then this year, we've still seen the rent growth, but without the demand. And that's kind of been the high level change over time of the last few years, at least at a national level. So here is just another way of looking at the new supply and the net absorption. This is on a monthly basis and maybe just a little bit more clearly showing you from a time perspective where these incongruities really came. So, through 19 and again, really even through 2020, you saw a pretty tight bunching of new units and net absorbed units, meaning that the new supply really was not materially affecting average occupancies. Really at the end of the first quarter of last year, through the third quarter. So kind of second and third quarter of last year is when we saw the really unusual apartment demand. We saw the new supply again kind of stay on that steady trajectory. And so the deficit created there really drove a lot of the results that we've seen since that time and continue to impact what we've seen this year. And then because of really how dramatic that decline in net absorption has been in recent months, you see that, now really for all of 2022 through the first half of the year, we've been in a situation where nationally we've had more new units delivered than net absorbed units. And so that over time will start to soften average occupancies. The other thing I'd point out on this chart is just in the last couple of months of data, we have seen a pretty significant decline in deliveries. That could just be a blip. Sometimes, a property, the units hit in one month or they hit 3 days later, but it's the next month. And so those numbers, on a month-to-month basis can move around a bit. But it is worth pointing out that we have seen a little bit of a decline there in deliveries in recent months. So this is just kind of a regional look below the national numbers. This is new units over the last 24 months. Obviously, Texas stands out there, number one in the country, which is not unusual. Dallas, Fort Worth, and New York are generally kind of vying for 1 and 2 at the market level for new supply. Dallas has been pretty consistently number one for the last few years. And then, of course, you've also got Houston that builds a lot. And really, you could put Austin in there as well, but Dallas and Houston really drive the Texas numbers. You got Florida there, number 2. I know it's a little bit small, but about 88,000 new units over the last 24 months. And then California at number 3 at a little over 50,000. So those have really been your epicenters of deliveries. You can see in the Mountain West in particular, you've got a pretty big difference between Colorado and Arizona, and then the remainder of the region not outputting a ton of units. Boise, obviously has been one of the fastest growing markets in the country in the last few years, but it's still a small market. So when we're looking at just aggregate units added, we're not going to see much there. But Texas, Florida, California really leading the way, as well as the lower Atlantic in general. Same thing here, but for net absorption. So again, the net change in the number of leased units for this 24-month period. Again, same 3 states are the sort of the big 3, and this makes sense that these are the 3 states with the most new units, or the most units for multifamily in general. So you would expect that, but kind of in a category of their own, particularly Texas, both for new supply and for absorbed units. It's almost as much as Florida and California combined. And interestingly, Chicago struggled a bit during the pandemic era. It was one of those markets that took longer to kind of start the recovery. But you see, over the last 2 years, pretty good absorption number for Illinois, which is mostly going to be driven by Chicago. A pretty low number for New York, you can see up there, less than 14,000 net units. So that really highlights kind of the recent time that New York has had in the last couple of years with some population loss and a slowdown in absorption. And then notice again the lower Atlantic states, really pretty large numbers for those markets. And kind of merging these two to show kind of the net effect of the new supply and the demand is basically what I did here was I took the new units by state and I subtracted from that the net absorbed units. So for example, Texas there at about negative 50,000 units, that means that about 50,000 units more have been absorbed than added in the last 24 months. So a sort of a deficit of supply, if you will. You see California over there, even though the California Bay Area has struggled more than most markets, still more than 30,000 more units absorbed than added in the last 2 years. And so, this is something too that's going to drive a lot of what we see in these slides is, the demand explosion from last year, along with relatively stable new supply, just threw out of whack the supply-demand imbalance for a lot of markets around the country. And that's something that's going to take time to work out, whether that's through increased deliveries or reduced demand. But that's something that took some time to accumulate and is going to take more time to dissipate. And then lastly, because new supply is having such a large impact right now on what we're seeing in the space, we track kind of 2 things when it comes to new properties: the average construction time, which would be the number of months between a construction start and a lease start, and then the lease up duration, so a lease start to stabilization. And so construction times, you can see, have been trending up over the last handful of years, particularly in 2020 and 2021. Obviously, 2022, we're only halfway through the year, so there's a little bit of a sample size issue. We're comparing a half year in 2022 to the full years of these recent years. But nevertheless, we are 6 months through the year. It's a big enough sample to tell us something. So, for properties that have begun leasing so far this year, you can see that the construction time was even longer. than for properties that began leasing even last year. So construction times continue to elongate. Lease up times have been winnowing. This year, again, if the average holds, lease up times are going to decline from 2021, which was a slight decline from 2020. So, really this is a picture of healthy demand, particularly in the Class A space, given that most new properties are going to come in as a Class A. And then, obviously still the difficulties facing construction, whether that's labor shortages and costs, materials, and also now we see with the cost of capital rising, now we also have to deal with the finance picture sort of changing on the development side as well. So all of that has kind of combined to have some pretty notable impacts both on rent and occupancy. I know there's kind of a lot on this chart, but what we're looking at basically is the average market rent per unit, which is going to be the top of that sort of gold shaded region. So this is going to be the average rent if a new resident comes in and asks, what is the rent today, a prospective new resident, which is important to note because that will skew the average rents a little bit higher. We're not able to capture, unfortunately, renewal rent rates. So these are going to be rents for new leases. Just kind of keep that in mind. Average effective rent is basically the rent minus any lease concession or discount package that they're offering for a new lease. And then average occupancy is on the right-hand side here, the white line corresponding to that y-axis. So really the width of this gold band is your lease concession. And you can see that it, of course, lease concessions rose during 2020, winnowed in 2021, really after the first quarter of 2021, and have not really materially started coming back. Whether you look at concessions based on availability or the average concession value, both of those have trended down really all through last year, and they've continued to trend down this year. That's not something we've seen reverse yet, but that is something that we're looking for in the second half of the year that we would expect, certainly on a market by market basis, to start seeing operators kind of pull that concession lever a little bit more. So also you'll notice, obviously, just the trajectory of the rent growth here last year, a little bit of a slowdown in the fourth quarter rather, and then has picked right back up in 2022. Again, even without the apartment demand to match. And part of the reason for that is average occupancy being so high. So you see the dramatic run up in occupancy through last year. And even though occupancy has now softened for 6 or 7 months in a row, thanks to sort of the trend change in demand, occupancy remains higher than it was, whether you talk about going into COVID or just sort of in the pre-pandemic period, occupancy remains 1.5% or 2% higher. So it's really that occupancy that still is providing some running room for rent growth, in addition to the larger gap between someone who signed a lease 12 months ago. Now they're up for renewal. The operators are trying to capture all that last 12 months of rent growth in a renewal if they can. So that's adding some momentum to rent growth as well. But a lot of it has to do with the fact that even as occupancy has slid down, we're still above where we would normally be, both for this point in the calendar and just in general. And just zooming in a little bit on the rent change specifically. So instead of looking at this, the rent on a monthly basis, we're looking at the percent change on a monthly basis. And so once again, you can see, really about the end of the first quarter last year is when the rent growth really started taking off. It kind of plateaued in the late summer, going into early fall, and then fell all the way through about January or February of this year, where then it started to rebound again. And so that's where you get, there's markets around the country where we're already at 8, 9, 10, 11% average effective rent growth just through the first 6 months of the year. And again, what does that look like from a regional perspective here over the last 24 months? The Mountain West stands out, so does the Lower Atlantic. Those are really the two regions that stand out. But also, I just kind of wanted to show that with only a handful of exceptions, just how widespread the rent growth has been. this is over a 2-year period, but even some of the lower values for some of the Midwestern state or the Great Plains states, Iowa, Missouri, states like that, those rent growth numbers over a 24-month period are obviously just mind blowing. And then you see states like Florida, Idaho, up there at 40%, Montana, Arizona, and you start to see a little bit of how the affordability picture has changed over the last couple of years. So like I said, I did want to cover a little bit of price class information just because I think this gets to one of the big sort of shifts that we've seen. Here we're looking at price class average occupancy, a little bit of occupancy softening in all 4 price classes in recent months. A little bit more in the Class B and Class C sectors. But also notice that all 4 price classes, the average occupancy remains higher than it was going into COVID. And, as I said, that's a big factor for rent growth generally, but also within the price classes, we've seen demand cool off, but occupancies, because they ran up so high last year, still are higher than normal, and that's kind of providing some rent momentum. So here we're looking at the same thing, but for average effective rent. And I've got sort of the year-over-year changes there on the far right side. And again, sort of a main theme last year when we were tracking just kind of everything that was going on was how broad-based the demand growth was, the rent growth was, and that kind of has held true this year too, in terms of apartment demand is down kind of across the board pretty consistently. The rent growth remains elevated pretty consistently across the board, whether you're talking about different markets or regions, different market sizes, different price classes, kind of any way you subset the data. The rent growth remains high and the demand is lower. But you can see here that for price class A, you've got 16% year-over-year growth. Same for B. Class C is 15%, Class D 10%. So all 4 in double digits, and particularly for the Class C and D space, that's where we talk about affordability concerns really impacting demand. A 16% increase in the Class A. People are going to notice that, but it's more manageable, generally speaking, than for a Class C or a Class D resident. So zooming in a little bit on the demand change. Here we're looking at the last 5 years, January through June, so first half of the year for each year, and net absorbed units by price class. Again, I know there's kind of a lot on here to look at, but a couple of things I wanted to point out for you is one, across the board, absorption is down this year compared to the first half of last year. And also you'll notice that for Class C and for Class D, this year's absorption through June is pretty significantly outside of the range that had been established in those previous years. Whereas, at least for Class A and for Class B, the absorption number this year, while down from last year's peak, is at least a more sort of typical level. Certainly the Class A space. I mean, Class A this year looks a lot like 2019. Class B, still a shortfall from 18 and 19, but not as dramatic as we see in Class C, where net absorption has barely been in positive territory in the first 6 months of the year, or Class D, where that negative absorption, meaning that they're actually less net rented units now than at the start of the year in the Class D space. And then you can see there just the percent change from the 3-year average previous. So from 19, 20, and 21, that average compared to the value this year, Class A has been the most resilient, down less than 10%. And you can see how dramatically that escalates as we move down through the price classes. So, real pain point in the Class C and D spaces, but a real fall off in Class B as well. Maybe, there we go. So same thing here, but for rent change. And Similarly, across the board for all 4 price classes, rent growth through June of this year has been higher than in any year of this 5-year period, even more than last year. One caveat there would be that the rent growth really didn't start in earnest last year until March or April timeframe. So the 2021 rent growth numbers here for January through June really all came in a 2 or 3 month span last year, whereas this year rent growth has really been there from the start of the year. So if you think about it on a per month basis, the rent growth this year has slowed down some, but in terms of year to date through June, rent growth is higher across the board this year. And you can see, class A up there approaching 7% already. So that's going to be kind of a main theme here is, as occupancies trend down and as absorption has been muted for really like 8 months now, rent growth has so far not really crested. It looks like, there are signs that we may be getting to the peak, and we may have already hit the peak, but certainly through June, there was no slowdown in the first half of the year. And so upcoming new construction, right? So this is going to be one of the things, especially for a lot of markets, a lot of the growth markets around the country. I relocated from Dallas to Tampa in the last year, and both of those markets are good examples of growth markets where tons of people are moving. And one of the things that's going to help alleviate some of the really eye-popping rent growth numbers will be rebalancing that supply and demand dynamic. And so upcoming new construction, we're tracking almost 3.5 million units in the pipeline. Only projects that we expect to break ground in the next 2 years, rather, the next 24 months are included in these pipeline numbers. So that's kind of how we cut that off. So particularly in the pre-construction phase, meaning that these properties have not yet broken ground, we're not going to include properties in those numbers unless they're due to break ground in the next 2 years. So you can see, about 60 to 65% of the overall pipeline in a pre-construction phase. That's pretty typical. That gives some added flexibility, especially now with so much changing in terms of the broader economy and the labor market and things like that. Should the situation materially change for lease-up properties entering the market, there's a big chunk of the pipeline that can be put on hold or delayed as needed if that's something that does become necessary. So a pretty good ratio there in terms of pre-construction units to the overall pipeline. On the right-hand side, we're looking at top 10 markets by pipeline units. A little bit unusual there. Normally, as I said, it's Dallas, Fort Worth, number 1, New York, number 2, and then you'll have, DC or maybe LA. But we got New York back at 1, the California Bay Area at 2, and then you got Seattle, LA, Dallas, Fort Worth. So it's just, it's interesting that the Bay Area struggled a little bit the last couple of years. So a little bit of a surprise to see it so high up the list. Also one of the main markets that lost population in the last couple of years. But California has this dynamic that a lot of states don't, where that's not really a state that's relying on population growth for its housing demand. If anything, it's overpopulated, right? They've got too many people. But it is just interesting to see, again, the Bay Area, Seattle, not usually that high up the list in terms of pipeline units. So a little bit of a shift there in where the pipeline is going to be outputting units. And so for this section, just kind of some quick wrap-ups here. As I said, demand over the last couple of years, we can say that it rebounded in the back half of 2020, exploded in 2021, and has receded substantially in 2022. What has the impact of that been on other KPIs for the industry? Well, as I said, it sent average occupancy up or vacancies down. It sent lease concession availability and value way down. And that's something that on the concession front, we have not seen reverse yet this year. On the occupancy front, as I said, we have seen occupancy start to soften. And Class A, as I said, some built-in advantages, higher incomes generally, jobs that maybe can be made hybrid or remote more easily, maybe potential homeowners that are still renting due to what's going on in the single family space. But we've definitely seen Class A from a demand perspective be the most resilient this year in terms of the price classes. And then in a lot of markets around the country, for the sake of time, I didn't have a lot of time to dig into actual markets, but the shortfall in demand has kind of been covered up by a slowdown in deliveries in a lot of markets. And so that's something where as we continue to get more deliveries, if the demand continues to be muted, we'll start to see more occupancy softening in those markets. And I'm seeing some, question. Oh, wow. So the questions, I can't really scroll through to see the whole question. So, well, let me see. Let me try to read this one. We may have to hold those to the end just for the sake of time. So yes, I will get the questions that you've put in via text. I'll get those at the end. It's kind of hard. I can't really make out the full question for whatever reason. Sorry about that. So before we get to kind of some of the drivers of demand and how things are shifting on a more micro level, we did have a poll question. And Tristan, were you going to be able to throw that in for us?
Yes, he's going to throw that in.
In the meantime, I'll try to expand these questions. And Michelle, is the poll question in there and I just can't see it?
Yes, yep.
Okay.
There.
Okay. So
yeah.
Do you want to just read that for us?
Sure. So the quick poll is, if your organization has experienced an erosion in market conditions in the last 6 months, where has the impact been greatest? So the options are new resident interest and rent growth. The second option is renewal interest and rent growth. The third option is delinquencies. The fourth option is no significant changes. And the fifth option is conditions are better than 6 months ago. And we should have poll results now.
We'll circle back to those at the end. So yeah, let us know what you're seeing, kind of boots on the ground in your specific market or with your portfolio. And then, okay, so this question, could the new units in California be due to construction holds throughout COVID that are now back on track? So they are catching up now, but will slow down in the future. I mean, there's definitely some of that, and California would be kind of the prime state where that might be the case. You know, average construction times in California are well above the national average. Also in those numbers, I included total pipeline. So that will include pre-construction properties. And, you know, sometimes that can fluctuate a little bit just based on, you know, when properties either get put into that planning phase or, you know, that 2-year threshold cutoff that I talked about. But yeah, in states where it was harder than in others to get construction done, sort of during the pandemic period, there will be a backlog of units there for sure. So yeah, that's a good question. Unless I'm mistaken, that's all I see in there. So I'm going to move on for now. So some of the drivers of the results that we've been talking about. So one, we of course have to talk about population change and net migration. Let me see if I can get that out of the way. So, you know, the US population has been growing at a slower pace, you know, really going back the better part of a decade now. You can see, you know, pretty dramatic drop-offs, in particular starting in 2017. And so, you know, as the population growth slows, it's going to be more important to pay attention to the net migration numbers domestically. So if we're not getting the same number of new people, then we need to pay we need to especially pay attention to where are the existing people moving to and from. Maybe, there we go. So I've got 2 slides here that look very similar. On the left-hand side, we're looking at really last decade at the state level. And then on the right-hand side, we're looking at that 3-year period, 2018 through 20. The 2021 data is out, and we're going to look at that on the next slide. But the reason I've included both is just, well, a couple of reasons. One, the Census Bureau has kind of had some difficulties putting out some of the data sets they normally do with COVID collection errors. Well, that's the reason they gave. So some of the data sets have not been available. Others have been available, but either more limited or with some additional kind of variance in there. So the reason I bring that up is just there's kind of some weirdness in the 2021 numbers. If you look back at the 2020 revisions that were done in 2021, there was quite a bit of movement there, which is unusual. So this is the sort of pre-COVID data, and then the next slide will be including the COVID period, and just kind of take a grain of salt with our next slide with the 2021 data. Is just, for example, New Jersey went from losing population to gaining like 4%. So just kind of some weirdness there. But generally speaking, from a migration perspective, the growth regions have been the same regions we saw stand out in new supply and net absorption: the Mountain West, the Lower Atlantic, and Texas. You could say the Southeast region, or Lower Atlantic, but Mountain West and Texas especially. And then even in that 3-year period, 18 through 20, you saw kind of a strengthening of those trends that had been in place for the full decade. So states like California, Illinois, New York, West Virginia that weren't doing well did less well in that 3-year period. And then the regions that were growing in the 10-year period stood out in the 3-year period, especially Idaho being driven mostly by Boise. So those are kind of your growth areas. Adding the 2021 data in there, again, on a decade level, it's mostly the same: Mountain West, Texas, Lower Atlantic. On the 3-year period from 19 to 21, it's a little bit more muddled, and I think some of that could also have to do with people that left the dense urban markets in the early days of COVID, went to the more outlying areas or secondary markets around the primary markets, and then ended up moving back into those areas in 2021. But in terms of the area that consistently stands out, Boise is sort of in a category of its own. But again, from a growth perspective, we're talking about the Mountain West, Texas, and the Southeast or the Lower Atlantic. So at an MSA level, top 10 MSAs for population change just within the 1-year period from 20 to 21. Probably not a lot of surprises on that list. The Riverside San Bernardino market in California, sort of the Inland Empire area, was an area of California that did well during the pandemic. The Bay Area and LA struggled more, and the Inland Empire area did relatively better from a California perspective. But you see Texas, Arizona, Florida represented on that list. Bottom 10 MSAs, obviously this is going to be skewed toward the largest markets just because we're talking about aggregate change in terms of people. But you've got New York, LA, San Francisco, Chicago, probably not a lot of surprises at the top of that list. Miami, Fort Lauderdale, it's interesting actually to see on the top 10 list for most population loss. I think that probably has more to do with the fact that a lot of the population growth in the Miami area is outside of Miami proper. But I wanted to show the same thing here by percent change just to kind of take care of that large market bias. And so really what you'll notice here when we're talking about top 10, bottom 10 for population percent change is that in the growth states, and again, Mountain West, Texas, Lower Atlantic, it's not just the major or the primary markets in those states where we've seen the strong population growth. It's really throughout those states. It's in the secondary and tertiary markets as well. And that's where you see, in this top 10 list, a lot of smaller areas, but in those growth regions. Whereas for bottom 10, you see a couple of the big markets even showing up on a percent change list, like the Bay Area, like LA, New York is in there too. So that's kind of an indication of just what the pain point has been like there for population loss. And again, for those markets specifically, You could argue that there's sort of too many jelly beans in the jar as it is, but nevertheless, it's noticeable. It's notable that they show up both for aggregate people and percent change. And then you've also got, Honolulu on there, probably not that surprising, and then some tertiary markets, mostly geared toward energy, which makes sense as well. So moving to the employment picture, because I know I'm running a little bit long here. The labor force has almost recovered in terms of the size of the labor force from the pre-COVID period. A really small kind of shortfall to be fully back, but you can also see that the progress kind of stalled in February or March of this year. We now got a couple of months with sort of sideways movement. The unemployment rate, I'm sure we've all seen the headlines of particularly tech layoffs and rescinded job offers, and is the labor market softening? So far in the national data, that's not something that's showing up. You can see the most recent June numbers. It was actually a slight downtick from the previous month. Labor force participation rate has been staying pretty consistent, so I don't think that downtick is due to people leaving the labor market. There's some there is some softening showing up within certain sectors. I would say, we've seen retail, hospitality, leisure start to soften a little bit, but overall we've not seen any regression in the unemployment rate yet, or a dip in the labor force. And I just wanted to show kind of an example of two different markets. These are markets I've spoken in recently, and I updated the data for us today, but a lot of markets that struggled a little bit more, sort of 2020 through kind of the first half of 2021, maybe that were a little bit later to join the rebound party, whether that was with demand or with rent growth. Like LA, a lot of them look like this from a labor force perspective, where the labor force still has not recovered from sort of the initial shock of the COVID pandemic onset. And you can even see in the LA numbers that they've gone down in the last couple of months, actually. Whereas on the right-hand side, we're looking at the Tampa market. This is pretty typical of a strong growth market over the last couple of years that saw 20, 25+% rent growth and all that kind of all that kind of thing. The labor force in those markets tends to be larger now than it was in the months leading into COVID, and you can see the difference in Tampa, where that trajectory is pretty solidly up still, whereas there's been a little bit of a bump in LA. So it bears keeping in mind, region to region and market to market, that there still are some pretty dramatic differences in how the labor force has recovered from sort of the initial COVID period. So here we're looking at layoffs and discharges. As I said, with the unemployment rate, we're not really seeing in the national numbers yet much softening. Layoffs and discharges haven't ticked up in recent months, and really have kind of been at a level lower than the months leading into the pandemic. Job openings have moved a little bit more sideways lately, a little bit of a downturn in the most recent data. We really saw the big increases in the job openings throughout last year. And again, the job openings data is one where on a sector by sector basis, there are some differences. As I said, retail, hospitality, leisure are areas where we have seen openings start to drop off, whereas in other areas it's more of a tapering of the growth, or sort of a sideways movement. So not a ton of softening in the labor market yet, but of course that is something with everything else going on in sort of the macroeconomic situation that is worth closely paying attention to. And then, so I want to talk a little bit about single family, just because we're seeing a lot of changes there, obviously, with interest rates and everything like that, and it has an impact on the multifamily industry, to be sure. So on the left-hand side, we're looking at the National Association of Home Builders Housing Market Index. The July data just came out like a day or two ago, so I was just able to get this in. Basically, this is a survey of home builders, and they look at sort of current sentiment for the next 6 months, and then they evaluate the foot traffic they're getting for prospective buyers. They do a weighted average of those, and then they come up with the index value. So there's been pretty, the July number in particular was significantly lower than in recent months, but you can see there's been kind of a downtrend in place, going back a handful of months and really going back to the third quarter of last year. Again, things are shifting on the single family side. Builder sentiment, if you look at the historical data, like back to the Great Recession, builder sentiment took a nosedive in 2006, and it didn't really recover until 2012. And the recession really started, late 2007, somewhere in there. So this is kind of a leading indicator, and it's got kind of a wide range. Like I said, the values were trending down pretty significantly in early 2006 even. So this is something worth watching as we move forward. On the right-hand side, we're looking at the weekly mortgage rates. And two things I wanted to point out here. One is just, obviously the big jump here recently, but also just within the broader context, here we're going back to 2000. It's in a historical context, rates below 6% are unusual, right? So there is going to be some adjustment, I think, in the multifamily space if rates are at this level or higher for a sustained period, just because we've had this, basically decade-long period of free capital almost. And so that is going to be an adjustment. But again, just pointing out that it's unusual that rates are this low, and again, that's the jump in the last couple of months in rates has been dramatic even so. So active listings are still very, very low. Listings really fell off a cliff after 2019, haven't really rebounded. We've seen in the last couple of months a little bit of an uptick there, but not really a trend reversal necessarily. And on the right-hand side, we're looking at median sales price for multifamily. This is something that really has a big impact. We talk about potential first-time home buyers kind of phasing out of the multifamily demand pool. This is something that really affects first-time home buyers in particular. And so, it kind of remains to be seen as rates go up. We're already seeing some home builders say that they may curtail their development plans for the new builds. Cancellations seem to be on the rise in terms of, people that haven't locked in their rates yet, not being able to qualify for the house, things like that. So, some of this, I think the plates are just now starting to shift, and it's a little bit too soon to tell how all this is going to shake out. But certainly the lack of housing supply on the single family side is something that has impacted multifamily, will continue to impact multifamily. And it's just a question of, is this something that could help, particularly the Class A demand, where buyers are on the sidelines and they're still renting, or are those renters going to go maybe to single family rentals? And for the traditional multifamily, we won't see that boost. I think kind of the jury is still out on how that's going to shake out. Obviously, we have to talk about inflation really quickly. I put the consumer price index in here. The producer price index was over 11% in the most recent data. That's generally a leading indicator for the consumer side. So it seems like the consumer inflation is likely in the near term to continue trending up. On the right-hand side, we're looking at the top line items for inflation, and you can see that almost without exception, these are energy related. Airline fare is also mostly energy related. Cereals and baked goods on there. Russia and Ukraine account for something like 40% of wheat, I think, internationally. So it makes sense to see that there. But for the most part, in terms of top line items, it's still sort of an energy related story. That's not to say, various grocery categories are, 8, 9, 10%. Used cars and new cars are also in double digits. It does say something that even to make it in the top 10, electricity is at 14%. So there's plenty of categories that are in double digits year over year that wouldn't make it into the top 10. So inflation, obviously, a major issue and an issue that is not likely to dissipate in the back half of the year. Something else affecting affordability, there was a lot made of increased savings rates during the pandemic, and people using stimulus checks to pay down credit cards and things like that. That was sort of a heavily reported narrative. And so on the left-hand side here, we're looking at the personal savings rate as percent of disposable income. And these three peaks here, probably unsurprisingly, those correspond with the 3 federal stimulus payments. And so you can see the effect of those payments on people's balance sheets. On the right-hand side, consumer debt service, going into the pandemic, about close to 10% of after-tax income was going toward consumer debt payments. That trended down through the pandemic and now has been really making its way up since the start of last year, and is continuing to trend back up towards 10%. So some progress was made during the pandemic in terms of savings rates and things like that. For the most part, that progress has been given back. And so just to wrap up here, some affordability changes over the last couple of years in general. Those stimulus payments in 20 and 21 now have been gone for some time, although there are, last I checked, 17 states looking at doing some sort of stimulus payments in 2022 as inflation response payments. Some states are looking at doing direct deposit cash to people. Other states are looking at doing half direct deposit, half tax credit. California is sort of leading the charge on this. So that's something for multifamily that's obviously going to be worth paying attention to for those states and areas that do some sort of stimulus payment. That's going to have an impact on multifamily that's going to be different from those that don't. And you might say that it's maybe a questionable response to inflation that has a lot to do with so much cash being in the economy, but that is something that's being looked at. Child tax credit changes. So the expansion of the child tax credits expired at the end of 2021. That's something that no longer now is affecting household balance sheets in 2022. The expanded and increased federal unemployment benefits. So federal unemployment, the amount paid was higher, the number of people that could qualify was expanded. That also expired last year. Federal student loan moratorium still in place, but it expires at the end of August, pending any further continuation of that policy. Eviction moratoriums mostly expired, but not in all localities. I know LA, as an example, still has an eviction policy that's in place through, I think, August of next year. If the resident can make some sort of tangential connection to a COVID impairment. And then the savings rate in consumer debt, like I said, in 2020 and even into 2021, that was improving. And now those trends have reversed. And so kind of the wrap up for this section, and then we'll get into any questions that there might be. Domestic migration continues to favor Mountain West, Lower Atlantic, and Texas, largely at the expense of gateway markets. The labor market right now remains tight. There are some signs of building clouds, and as I said, particularly for certain sectors, we have started seeing some softening, but at the national level, nothing yet that's showing up in the numbers. Unrealized demand from 2020, increased resident disposable income, artificial boost from various government pandemic response measures have all been depleted. Kind of going back to that slide we just left, a lot of the sort of policy responses to COVID that were helping to boost apartment demand have now sort of exited the market, and we're seeing the effect of that with the muted demand this year. And then rising mortgage rates already impacting the for sale market. This should benefit multifamily. Again, I think the jury's still out on if single family rental will benefit more than sort of a Class A or Class B multifamily, but nevertheless, the situation on the single family side should have some positive benefit for multifamily demand as we move forward through the rest of the year. And so just to kind of give a broader wrap up, I would say, the annual percent change numbers for a big portion of 2022, I think we're covering up the change that had happened at the demand on the demand front. A lot of coverage was still well over the last 12 months, X number of units have been absorbed, and this is a historic number. But that was still capturing mostly 2021 numbers. And so now as we've gotten through 2022, now we're halfway through. As those numbers are accounting for more of the 12-month numbers, you're starting to see more coverage of the demand change. It's something that nationally we've seen absorption fall 75% thereabouts compared to last year. And so, as I said, occupancies have been trending down. That's likely to continue. If we see any improvement on the construction side, that will probably pressure occupancies even more. And rent growth in the back half of the year, we're expecting at ALN that rent growth will begin to moderate in the coming months, probably in the next couple of months. It looked like maybe rent growth had peaked about 2 months ago and then it picked back up again. But there's only so far that the momentum can take you. And again, part of it, because occupancies remain so high after last year's run up, that's prolonged the sort of the lifespan of this historic rent growth that we've seen, but we seem to be on the back end of that. And with that, I will open it up to questions, and I'll try to pull this up and see what else we've gotten in.
Thank you, Jordan. Did you want to just take a quick look at the poll results as well?
Yes. Don't ask me how to do that. I don't see the poll in my menu.
Okay, so the results, everybody else can see them, and for some reason, Jordan, I don't think you can. So new resident interest, 13%, renewal interest and rent growth, 8%, delinquencies, 15%, and then no significant changes, 42%, and conditions are better than 6 months ago, 23%. So
okay, awesome.
I think a lot of optimism and some good positive results there. I think everybody can see them.
Awesome. Trying to see if I missed any questions. It says, is New England not large enough to show? Oh, so yeah, on those charts with the numbers, the states labeled by number, most of those New England states are too small for that to fit. And so for those, you're more just looking at the color coding of the shading at the state level. And did I miss one, Michelle? Here's one. Has population migration changed since the height of the pandemic with work from home, cost of living increasing? Do we expect these patterns to continue? So what we saw in the migration numbers for the most part was kind of an extension of the pre-COVID trends. So the areas that had been growing pre-COVID continue to do that during COVID. The areas that were losing population or growing at a slower rate pre-COVID, that continued during the COVID era. So in some respects, I think it was kind of an exacerbation of existing trends. The work from home aspect is a little bit hard to read still, I think, just because for multifamily, one question is going to be what percentage of workers went full remote versus hybrid, because full remote, obviously they can move anywhere, presumably that has, an airport and Wi-Fi. Whereas a hybrid model, they're going to still need to be, within a certain range of their workplace. We've also seen more stories coming out about companies sort of reversing their decision on remote work and deciding to bring more people back into the office. And so I think we're still seeing how that's going to shake out. For secondary and tertiary markets in particular, I think the more we go to a full work from home model for people, the better for those markets. And then If a hybrid model tends to be what gets settled on, which seems to be the case so far, then you're talking about, different submarkets within a market maybe being affected, but not so much inter-market effect there. And I know we've hit 3 o'clock. Did I get every question? I'm still, it's giving me like a little sliver.
So I think there's one last one here with respect to renter payment delinquencies is typically maybe lagging. Any indications regarding trends in this, especially given this spike in inflation that you presented?
So we don't have collections data at ALN. It's something we actually were tracking in the early days of the pandemic kind of manually. It's not something we generally track, and we weren't able to kind of keep the resources up to do that. So I rely on the NMHC data, and I saw, I think RealPage put out a report a couple of days ago about what they're seeing within their own client base. That reporting seems to show that there has not been much of an increase in delinquencies. It's also important to keep in mind with data providers that are generating the data from RMS or PMS type softwares, that kind of skews the data set. Generally, those softwares are used at a higher rate in larger markets, on larger properties, more expensive properties generally. And so, as we saw in the price class numbers, Class A has done considerably better than the other 3 price classes this year. So if your data is a little bit more skewed that direction, then your delinquencies are also going to be skewed. So there may be some risk there. I don't know. I don't know enough about other companies' data. It's something that we just don't track, unfortunately. I can tell you anecdotally, just going around, speaking at a lot of events and talking to owner operators and management companies, it seems like in some markets there has started to be a little bit of an uptick in delinquencies, but that's sort of on a property by property basis, and that's purely anecdotal. So.
Great, thank you. I think we're through the questions, and I think we've hit our time limit. So.
Yes, we went over, so sorry. I hope that was useful, and again, thank you so much both to Michelle and Rooof for the invitation, and to everyone here for joining us.
Yeah, great. Thank you so much, Jordan. And we will, as discussed earlier, we'll make sure everybody gets a copy of the recording. So thanks again. Have a great day.
Bye, everyone.
Bye for now.